Welcome back to our special coverage of the RBI monetary policy. Now, to help us understand how this policy is going to impact our borrowing, deposit rates, and what it means for the banking industry, we now have with us Mr. Dinesh Khara, the chairman of the country's largest bank, State Bank of India. Mr. Khara, thank you very much for your time here. Just a quick start by telling us what you made of the policy. No change in rates and stance as expected. Growth projection also unchanged. Some downward revisions in CPI, but what stood out for you?
No, I think the policy is much on the expected lines, and the interesting part is that the inflation also is the projections for the inflation also which have been given. They are quite encouraging. Yes, of course, the policy do recognize the challenges which are there on the global scenario, but at the same time, it also talks about the resilience which has been demonstrated by the domestic economy as well as by the global economy. So I think these are some of the very encouraging features which have been demonstrated in the policy. Apart from that, there is a very clear focus in terms of how do we improve our payment system going forward.
Yeah.
So that is a very important factor which has been covered, because eventually, when the economy moves to the developed state, we have to see that the payment system should be very, very efficient, and that is very clearly reflected. And now leveraging UPI even for the deposit of cash in the CDMs. Earlier, it was being used only for withdrawal from the ATMs.
Yeah.
So all kind of convenience are being integrated into the payment system.
Yeah.
So I think this actually augurs very well.
Well,
And apart from that, yeah, you are saying something, Ritu.
please carry on, Mr. Khara.
Apart from that, this rupee interest derivative products also, they have now come out for the small finance banks also.
Yeah.
It has been made available, so it will even further develop the depth of the rupee derivatives as well, rupee interest rate derivatives, because eventually small finance banks were not having any kind of a tool available for the interest rate risk hedging. So now that is available. So I think that is the other very important piece.
Well, that comprehensively, Mr. Khara, covers both the policy and the non-policy measures. But let me get some more details from you. As a banker, how does life change? Because rates are now going to stay at the current levels for at least a few more months. So what happens to your borrowing and lending rate trajectory from here on is what we'd like to know.
I think it will have the stability as far as the interest rate environment is concerned. And in a way, it goes very well, particularly the financial markets don't like uncertainties. So I think from that perspective, the MPC has given the very clear trajectory as far as the interest rate is concerned. So I think it goes well, it augurs well in terms of the corporates also to take their financial decisions relating to borrowing, etc. So I would rather, I perceive that it's a very welcome step.
But Mr. Khara, but what is your sense? Because, growth remains on strong footing. Core inflation has been coming down. Of course, there's some uncertainty on food prices for the headline inflation. But when do you see the rate cut cycle beginning?
My expectation is that interest rate cut should be seen somewhere in the third quarter of this financial year.
Okay.
That's what my hunch is. But yes, of course, it is function of various variables which are being reviewed by MPC. But as of now, it looks like that we can perhaps get to see some kind of a interest rate cut in the third quarter of financial year.
Well, if the interest rate cut expectations are pushed all the way to the third quarter and rates are going to stay at the current levels for a while, for a bank like you, for instance, do you think even for the industry, NIMs will be protected then? That's good news for you. They'll stay at the current levels, if not improve?
I think hopefully we should be in a position to maintain NIMs at the current level, because that's my broad assessment is, of course, we have to deliberate in our ALCO, but my broad assessment is that we should be in a position to maintain the NIMs at the current level.
Mr. Khara, on the LCR framework, which the governor mentioned in the policy, they proposed some modifications to the liquidity coverage ratio framework to facilitate some better management of liquidity risk by banks. What did you make of it? What could have prompted this? And what are your expectations from this draft circular that will come up?
Actually, what used to happen because of the payment systems efficiency and RTGS, NEFT, etc., made available 24 by 7, 365. So the system was required to keep the excess liquidity because they were, RTGS, NEFT can hit at any point of time, during the weekdays and as well as on the weekend also. So just to ensure that no bank is is left out with some debit balance. All banks were required to keep some excess liquidity, which was my assessment is that it was as high as to the extent of about 50,000 crore. So now, virtue of the readjustment arrangement possible 24 by 7, and that is something the banks should be in a position to monitor it on a real-time basis, and which will actually unlock that excess liquidity which was required to be kept. So I think it will ensure even better and more efficient liquidity management.
Well, Mr. Khara, thank you so much for helping us make sense of the policy and what it means for banks and their borrowers. On that note, we're going to wrap up this discussion. Thank you very much for watching, but stay with CNBC TV 18 for all your news and updates.